Alright, investors. Today let's calculate the stock's fair value or stock's target price based on dividend discount model or DDM. As you know, there are three valuation models: DCF, discounted cash flow, which we considered previously, taking into example Magnificent 7 stocks. If you haven't seen this video, you can still see it just on the up right corner. You will see the link. You can click and see the video. Then also price income model, that's very simple, straightforward model. I will put the link down to this video. A link to the article where you can read about price income model, DCF model, and also the DDM model. Also, you will be able to build your custom simple app that calculates the target price based on the DCF valuation model. But this time, let's consider the DDM model or dividend discount model. This model is more accurate than DCF because it requires way less assumptions than DCF, and is more accurate than price income because price income model is for quick equity valuation if you don't have time, if you need to take some fast, quick decision, and if you have a larger peer base. But DCF model, DDM model, is good for companies that are regularly paying dividends. The only condition is that they should regularly pay dividends, and the dividend payment should not be very volatile. It should not vary greatly from quarter to quarter. To my analysis, company should at least pay dividend in the last 4 or 5 years, and the dividend payment should be stable. And then you can take this company and calculate its fair value using the dividend discount model. So basically what we need for that, we will be using financial modeling prep data points. Again, I will put the link down to this video with the descriptions of how you can connect the Google Sheets that we are using currently with the financial modeling prep. You should go to extensions, add the FMP into the extensions, and then you will have this FMP written. But how you can do this, I will put the link down to this video where you can be able to get your custom API key as well, with which you will be able, and then connect it to Google Sheets, and you will be able to upload this data. We need the income statement data. As you see over here, I gave you the formulas so that you can use it simply. You can copy this formula or go to FMP website. Again, I will put the link to the down to this video where with all the formulas that you can use. And as you can see, for the net income, I am basically putting equals FMP income statement, and then I open brackets over here, and first symbol A1 because our ticker is home or Exxon Mobil. Today I want to consider Exxon Mobil because they are regularly paying dividends. And let's see the Exxon Mobil's stock target price. And here in the formula, I'm putting the Exxon Mobil 4 because I'm interested to see the 4 last years. Ideally, you should take more. You should take 8, maybe 10 years for your observations. The more years you have, the better it is for your analysis. It would be more accurate, but just for the purpose of this video, for this example, I am taking 4 years. Then the next, you can see here period, you may leave it blank, or if you want quarterly data, you may indicate quarter, but then you should reconsider your data quarterly if you are building this model for a midterm range and want to reconsider each quarter. Then your model would be more alive. It would be reacting more to the market changes once the company is posting its earnings reports. But in this period, in this example, I'm just leaving it blank, and it will be showing just the annual data. For you can choose either annual or period or quarterly. Then the data type which you want, it can be CVS format or JSON format, but I'm leaving it blank because we just need data to be downloaded in Google Sheets. And then in the headers, if you leave it blank, it will download you everything from income statement, but we just need the net income and the revenue for calculating the DDM model. That's why I'm opening these small brackets over here and just putting net income and revenue here, then close the parentheses, hit enter, and it's extracting me financial data for home or for XOM ticker or Exxon Mobil. Then I do the same thing with revenue. As you can see, it already extracted me the net income and revenue. These two fields should be written exactly as in the data point. That's why I am placing the formulas in the green. Simply go to your blank space somewhere and hit this formula, like in my example. For example, you can copy this formula, just hit the enter, go to the black empty space, and it will be extracting you the data for Exxon Mobil company. Then we do the same thing for the balance sheet, but the formula is equals FMP balance sheet statement, and then you take the stock ticker, it's a XOM, then again period 4, these fields will leave blank as usual, and in headers we put total assets and total stockholders equity. That's what we need for calculating the our growth rate, the dividend growth rate. Then we need the dividend paid. It is with minus because company is paying dividends, the money are going out of the company, that's why it indicates minus over here. But the formula, you can see the formula, same first steps, FMP cash flow statement, A1 and 4, and then you put dividend paid. This field is taken from the FMP. If you put it other way, it will not fetch the data, it will not extract the data. That's why the word should be written exactly as here, dividend paid. Then you take the dates for which this was extracted, simply FMP income statement and a date. It's not necessary, but I'm doing it for the convenience so that you see that we are extracting yearly data. In this example, we are extracting data for each year. Of course, quarterly is better and you can take 10, 20 observations, but I'm taking only 4 and I'm taking 4 years just to facilitate everything so that you see how this model is working. Then what I do, I'm taking the dividends. This is the formula. You can see I press FMP historical price full stock dividend. That's basically the formula. And inside of these brackets, I put the stock ticker, which is XOM over here. Then hit enter and it is extracting everything. So we need the adjusted dividend field. As you can see, the company is paying dividends every quarter. So to get the yearly dividend, you should just add all this last 4 data and you get the sum here, which is equal to 3.84. The company paid $3.84 as a dividend per share annually, but each quarter it pays, for example, the last quarter, the company paid $0.99 as a dividend. That's the record day when the company declared then and when the company actually paid the dividend. But remember, we need the adjusted dividend. The reason why I fetched all this data is to make sure that the company is regularly paying dividends and to see the dividend growth. I am following the dividend growth, first of all. That's a good sign. That's the good shareholders' motivation, stockholders' motivation. And secondly, that's a good sign that they show the stability. It's not fluctuating, it's not volatile, it's not fluctuating greatly. For example, if it's $1, the next quarter it's $2, then it's 30 cents, then it's bad. But in this case, we see expanding dividend and stable. So it is rising, but from quarter to quarter, it is rising slowly from year to year. That's actually a good sign. That's why I downloaded all those dividends to make sure the company is paying them long time ago, not only last 3 months or 4 months, and also to see that they are stable and rising. That's why we've chosen this company. And you should also use DDM model if you see this trend rising and stable dividends. That's very important. Then we need the WACC. This is the weighted average cost of capital. I've explained in more details what it is in previous video, or sometimes analysts may refer to it as the required return. That's the rate that you use to discount your cash flow in DCF and discount your dividends in the DDM model. You will see later why we need this model. And here one important thing, when I was extracting dividends, you see that's a minus sign because company was paying dividends. The money actually went out of the company. And I simply multiply it by -1 to make this number positive, just for the purpose of our calculation, because we require a positive number. And as you can see, the formula is straightforward as well for dividends, FMP advanced DCF, because I'm using the DCF endpoint. A1, again, it's a stock ticker. And I'm putting here D2 because D2, as you can see, that's the name of the field, WACC, or weighted average cost of capital. Simply put, that's the price the company is paying for its debt and for its equity, for attracted and for own funds. In this case, it's 7.88%. That's in percentage. That's why here I divided by 100, because we would need this data converted to percentages. The last step is to fetch the last price, again with FMP. This is the formula FMP live full price, A1, that's a ticker, and last sale price, that's the name of the field that we need. This data would be updated regularly because that's a live price, which is showing 127.65. That's the last price of the XOM ticker of this share. So that's basically it. You need the income statement, you need the balance sheet, you need data from cash flow statement. Also, we extracted some dates. You need the dividend payment information, you need the weighted average cost of capital, and the last share price. So once you download everything, now you can go to the calculation section. As you can see, I have the calculations sheet in Google Sheets, and you can build it yourself. That's the dates I am fetching from the dates table that I've previously showed you over here. These are 4 years, and I'm fetching those dates in the following order: the last year, in our observations, the most recent year, then year ago, 2 years ago, and 3 years ago. Since we're fetching data for the last 4 years, I would be extracting this data in this order. Now the dividends paid, we have already extracted this data from this table, amount of dividend paid, and I basically copy everything to this table, the dividends paid that we extracted, the net income, the company's net income, revenue for 4 years, company's total assets for each year individually, then total stockholders' equity, or company's capital. Some analysts may refer to it as capital. Then the next step would be to calculate the ratios. As you can see, I'm calculating ratios for each year separately. So, for example, the retention rate shows how much money the company is leaving after paying dividends. As you can see, the Exxon is paying good dividends. And after paying all the dividends, company is retaining around 60% out of its net income. That's usually a good sign. It means the company has some money left after paying dividends. And then this money can go to capital, for reserves, you name it. And then that's a good sign. You should follow the companies that have this stable number or expanding number, which we see here. Yeah, we had a higher number in the previous year, but generally speaking, this number should be higher. If you compare the stock with the closest peers, you should choose the company with the highest retention rate. The next goes the profit margin. Profit margin shows how much money is left in the company from its sales. Sales or revenue, it's the total value of the company's sold product or service. And then the portion of net income, in our case, it's 36 billion out of 333 billion, which means that after deducting direct and indirect costs, after deducting taxes and other expenses, company is left with 11 shares from each dollar of sold goods and services. Also, the higher the number, the better it is, and if it's stable, it's even better. Then it goes the asset turnover ratio, that also important. It shows how much assets the company is using to generate revenue. For example, if company is using the same assets to generate revenue, and if revenue is expanding, that's a good sign. But if the company is constantly investing into assets, if it's buying equipment, if it's buying some property to generate revenue, that's a bad sign because some portion of their cash would go to the investments. That's why this number should be higher. The higher this number, the better it is. And the last one is the financial ratio of financial leverage. Financial leverage shows what's the percentage of companies' money that is used through debt. So basically, if you see over here, you see the formula. It's basically the total assets divided by total stockholders' equity. The higher the number actually may be better because, well, it depends. If the number is high, it means that the company is relying on debt more. But right now, as you know, there is a high cost of money because Fed is still lowering rates, but it's lowering it slow. And the cost of money is high. This may result in a higher cost for debt payments for the company. That's why during the times of economic uncertainties or when the cost of money is high, when the rate is high, this ratio should be lower because it tells that the company is relying on debt less. But during economic expansion or boom, this ratio, when the rates are low, this ratio should be higher because company is more stable, company is able to pay its debt, company can attract money, pay out its debt. But during economic instability, this can signify some credit risks, additional risks associated with company, or else a liquidity risk. So you should pay attention to it. So once we calculate all the ratios for each year individually, as you can see here, we extract averages. For retention rate, that's the straightforward formula. The retention rate we calculated for 4 years. I then do average and calculate the average number for those 4 years. Same, I take the profit margin, calculate the average, it's 0.05. Then asset turnover 0.84, and the financial leverage 1.96. Then once we calculate all the averages of the company, it's time to do finally very interesting part. We are calculating the dividend growth rate based on the Pratt model. So what we basically do, we multiply everything in here, retention rate multiplied by the profit margin, by asset turnover, and by financial ratio, by average numbers. And we get dividend growth rate of 6.98% based on the Pratt dividend growth model. Then we take the Gordon growth rate using the Gordon model. The formula is over here. I've written the formula for you to make everything simple. So you basically take the current share price that we extracted from here. You remember we've taken the current share price or the last share price, multiply it by the required return or WACC that we've extracted also, weighted average cost of capital over here. We have this number 7.8%. And then we have minus the dividend per share. This is the last dividend that company paid. This number, you should know this number. As you can see, the company paid this dividend. But since we're taking the yearly data, we need to take yearly data. You just sum it up, everything in here. Yeah, and you get the number 3.84. That's the number of dividend that the company was paying yearly dividend. Then you divide everything by open the brackets, current share price plus the dividend per share. That's the same number as here. That's the last known dividend that the company paid. Again, we take the yearly dividend. And once you use this formula, as you can see, it's written DDM D12 because it is taken from here for the convenience. I transferred it to in here. As you can see, that's the current share price. That's a last yearly dividend. I sum up all the 4 quarterly dividends and we get 3.84. And then based on this formula, let's return to the formula in calculations, minus dividend per share multiplied by the required return, which is 7.88. That we again extracted from our financial statements from over here, minus dividend per share, which is here 384, and then divided by current share price plus dividend per share, and we get the Gordon dividend growth rate, which is 4.56. The next step would be to go to the main thing. That's our model, dividend discount model. So first we need to calculate the dividend growth rate. Since we're taking 5 years, we're calculating dividend growth rate for 5 years. Well, for the first year, the dividend growth rate would be the Pratt dividend growth that we calculated previously, which is 6.98%. We take it from here. The last dividend growth rate is also known. We are taking it from Gordon dividend growth rate, 4.56. The dividend for the last 5th year. The growth rate. Then we need to calculate the growth rate for the second year. This is the formula, very simple formula. You can see it from here. You take the dividend, forecasted dividend 6.98, which we extracted from the previous step from the Pratt dividend growth rate, 6.98. You can see it here. And then we open the parentheses, plus opening the parentheses. Then we take the dividend growth rate by the Gordon model minus the dividend growth rate by the Pratt model divided by A6 here stands for year. Since we're forecasting the dividend growth rate for the second year, we're taking 2 minus 1 divided by 5. I take 5 because we are forecasting dividends for 5 years minus 1. That's just the formula for calculating the dividend growth rate for the second year. Then for calculating the dividend growth rate for the third year, it's basically the same, but now you take the dividend growth rate for the second year that we just calculated, plus the dividend for the last year minus dividend growth rate that we calculated previously, divided by 3 minus 1, because we are forecasting for the third year, divided by 5 minus 1. And for the fourth year, you do almost the same calculation, only change the dividend growth rate. This time you take the dividend growth rate for the third year that we calculated, plus dividend for the last year, minus dividend for the third year, divided by 4 minus 1, divided by 5 minus 1. That's a simple formula. And dividend for the 5th year, you already know, we extracted it from the Gordon dividend growth rate. So once you calculate the dividend growth rate, it's time to actually calculate the actual dividend payment for the next year. That would be our forecast. For this, you take the dividend that was already paid. This number is known. As you saw, we've taken it from the FMP data from over here. We know the number of the amount of dividend that was paid quarterly, and we sum it up for 4 quarters because we're interested in yearly dividend payment, and we get this number 384. So you take this number 384 multiplied by 1 plus dividend growth rate for the first year that we already forecasted, 6.98. And the company's forecasted dividend for the first year is 4.11%. Now for the second year, you take the forecasted dividend for the first year plus 1 plus dividend growth rate for the second year that we calculated previously. Then for the third year, you take the last forecasted dividend payment plus 1 plus dividend growth rate for the third year. For the fourth year, this is the formula. You can see 4.64 multiplied by 1 plus growth rate for the fourth year. And for the 5th year, we take the dividend forecasted for the 4th year plus 1 multiplied by 1 plus dividend growth rate for the 5th year. Then we calculate the terminal value or forecasted company's future value, terminal value per share. It's given here, which is basically the dividend for the 5th year that we forecasted, multiplied by 1 plus dividend growth rate for the 5th year that we calculated, divided by required rate of return or weighted average cost of capital. You also can call it like that, 788 in our example, minus the dividend growth rate for the 5th year. and you get the forecasted company's value per share, which is 161.68. Then you do the main part, which is discounting. We discount our calculated dividends. The point of discounting is that we want to see what is the value of the dividend today. So, for example, we forecasted that in 1 year the company would be paying dividend which is equal to 4.11. But what is the value of this dividend today? It's 3.81. How we calculated it? We take this forecasted dividend for the next year, which is 4.11, divided by 1 plus weighted average cost of capital or required return, which is 7.88%, and in the power of 1 because we are forecasting discounting for the first year. Then to discount the second year, you take the calculated forecasted dividend for the second year, which is 4.37 divided by 1 plus the required return 788 in the power of 2 because we're forecasting for the second year. For the third year, the same forecast, dividend forecasted for third year divided by 1 plus the required return in the power of 3. For the fourth year, same calculations, that's the formula. And for the fifth year, we take the dividend forecasted for the year 5 divided by 1 plus the required return in the power of 5 because it's a fifth year. The same thing we do with the terminal value. We know that in 5 years, the company's value per share would be $161 per share. And to forecast it, to know the value of it right now, given the required return 788, we simply take 161 divided by 1 plus 788% in the power of 5 because we want to know the value of our company now. So it is giving us 110. The last step is to sum everything up. All those forecasted dividends, including the terminal value, we sum it up and we get the stock target price, which is 129.05 in our example. And the current share price of XOM ticker is 120.76. And then we basically calculate the price difference, which is basically the target price minus the current share price divided by the current share price. And we get the 6.86%, which means that the Exxon company or XOM ticker has 6.86% gross potential based on the dividend discount model. So that's basically, thanks very much for watching my model. Again, that's not my model, that's my calculations, but that's well-known model. Again, if you want to watch the video on how to calculate the stock fair value using the DCF model, you can watch the previous video. And thank you very much for watching. Just hit the like button, subscribe, and check out my Twitter, or currently named as X, for more stock market insights, analysis, and useful equity valuation apps. Thank you very much for watching.